Greetings, my name is Jeffrey Smith, and this is a quick example of calculating the maximum allowable offer for a fix and flip or fix and rent property. We start with the hard money sell spreadsheet. That is, we're using hard money to finance the property, acquisition and repairs, and we intend to sell the property to a retail buyer at the conclusion of the project. This spreadsheet has several tabs, several worksheet tabs. The first tab is the property analysis worksheet. There's a pro forma income valuation for rental properties, and there's a comparable sales sheet for fix and sell. I have already filled in some sample numbers for 3 comparable sales and come up with a average price of $152,333 for the average sale price. If you were pricing properties on square footage, you would use the estimated ARV over here, which is based on the property square footage times the average price per square foot. However, in this example, I'm using just the average adjusted price, which is the sales price with an adjustment for seller concessions. Back on the main worksheet, we have the property address, and this is a 1-unit property, 1,650 square feet, 3 beds, 2 baths, 2 parking. The after repaired value is a formula reference over to the comparable sales page. We also have down here the investment to value is simply the 80% of the after repaired value. This represents the all-in on the investment. From this number we subtract closing costs to buy the property, any other miscellaneous costs. We have estimated $20,000 for repairs, subtracting a supervision fee. This is initialized to a formula of $2,000 per month, or 3% of the after repaired value, to pay yourself to cover your personal expenses while you are working on this project. Also, we have a wholesale profit calculation. If you want to assign this deal to someone else, you build in the wholesale profit. This is initialized to a formula of $6,000, or 3% of the after repaired value, or 15% of the profit. These numbers are entirely in your discretion. You can increase them or decrease them or eliminate them depending on your situation. Carrying costs is a formula reference down to the calculated total carrying costs, which is determined from the annual property taxes, annual property insurance, prorated over the total carrying days, calculated as 30 days to repair, 30 days for marketing, 30 days for closing. We've also included 12% annualized debt service, interest only, on the amount borrowed, and that comes to $1,020 per month in interest-only debt service. This is included in your total carrying costs. I'm also guessing $100 per month for utilities. Back up here we have staging and marketing as a miscellaneous entry cost. I'm guessing about $500 to stage the property with rented furniture and hold a professionally catered open house. As you can see, we itemize each of these values and then subtract from a running subtotal. This is the end of the entry cost section. This is the end of your hard cash requirements to enter the project. When we are exiting the project, we have costs on the way out that are soft costs. Cost to sell, about 1% of the ARV to sell the property. This is to cover the paperwork for the closing agent, the title company, or the attorney that will close the transaction to the retail buyer. If you were renting the property and refinancing it with long-term, low-cost finance, there would be a cost to refinance instead, so you'd plug in the value here. Buyer incentives. We want to sell this property, so we want to encourage the buyer to complete this deal, so we offer to pay 3% of the closing costs. Cooperating commission with brokers. I'm guesstimating about 6% to have brokers market and list the property and to bring a buyer that's ready, willing, and able to purchase this property that's worth 6%. Participation share is something that you would offer to your private financier or to offset your capital gains tax on this transaction. We won't use that here. Finance charge, this is a formula reference down to the straight note interest cell, which is calculated at a rate of 20% simple interest, which is really a formula reference to the hard money effective rate when we are rolling in 5% or 5 points of the borrowed money into the loan amount. That equates to an annualized rate of 20% because we're holding the property for 90 days, which is just 1/4 of a year. Once we subtract all of these costs from our investment to value, we arrive at the maximum allowable offer. If you pay more than this to buy this property, the difference will come out of your profit margin or out of your pocket. Now the maximum offer plus the entry costs is $100,587. This is the total cash requirement for this transaction. The exit costs are soft costs. You don't need cash for that because the buyer pays these costs. They are charged to you on your HUD-1 settlement statement when you sell to the retail buyer. Therefore, you have to charge these costs to the motivated seller when you buy the property as a reduction in the purchase price. Now, taking the acquisition plus entry costs and dividing by the ARV, we come up with 66.69%. That is close enough for hard money lenders to lend all of the cash required to purchase this property. That is, you will receive $101,587 cash from the hard money lender, and you will sign a note for $106,667 to be repaid in 3 months, along with monthly interest-only payments. So you're really buying the property with 100% financing and fixing it up with 100% financing. Now let's go over to Microsoft Word and summarize this deal. In this property analysis summary, we see this is a hard money sell analysis. We have the property address, a summary of the property details, and now we have the cost analysis. Starting with the ARV, we subtract the profit margin for the total investment to value. We then summarize the entry costs. These are hard costs to get into the deal. Summarize the soft costs. These are the costs to get out of the deal. Total cost subtracted from the ITV leaves our maximum allowable offer. We also calculate a 20% reduction in the MAO as the initial offer of $50,700. This gives us some negotiating room. Next up, let's do a hard money request. Hard money financing request. This would be the summary of the deal sent to the hard money lender, explaining where the money is going, where it's coming from and going to. That is also called sources and uses. We show the monthly debt service is estimated at 12% annual rate. This is interest only. We also show that the total amount that we're borrowing is 66.69% ARV. That's close enough to the 65% ARV that if we wanted to, we could reduce the assignment fee and the supervision fee to get this number down below 65%. We're also offering 5% of the loan amount as points rolled into the private note. Now the price justification is what we would show to the motivated seller or to the listing broker for drafting a contract. Here we show just the total investment to value is $121,900. We show our cost going in, our cost coming out, and our maximum allowable offer is $63,417. This is similar to a letter of intent that is used in commercial real estate, but it's just a one-page summary showing how much we intend to invest in this property. We are for profit. We are not a charity. We don't work for free. If the seller agrees with this and wants to accept the maximum allowable offer of $63,417, all they need to do is sign this, send it back, and then we will draft a binding contract to buy this property. Now let's go back over to Microsoft Excel and look at the hard money fix and rent scenario. In the fix and rent scenario is a little bit different. We start with a pro forma income valuation. On this worksheet, we're looking at $1,200 a month in scheduled rent, minus a credit loss for deadbeat tenants. Gross operating expenses is initialized to the annual property taxes, annual property insurance, and the annual HOA amount. We're looking at a debt coverage ratio of 1.5. That is the net operating income divided by the debt service equals 1.5, meaning that the net operating income is 50% larger than the debt service. We're calculating a refinance loan-to-value rate of 70% with an annual interest rate of 5.25%. Amortization term is 300 months. That's 25 years. So the debt present value, $100,200. This is how much debt the property can support with these income and expense parameters. So the property value after repairs would be $143,100. Now on the analysis worksheet, there's a little bit of difference here in that we're showing that the investment to value is now 70%. That is a formula reference to the loan to value rate. The ARV is $143,100. That's a reference to the pro forma property value rate. We have deleted the cost to sell, the buyer incentives, and the cost to refinance is now set to 2.5%. The profit is no longer profit, it's actually retained equity because we're not selling the property, we're just refinancing it. Our maximum offer is now $54,965 with entry costs of $38,080. The total acquisition plus entry cost $93,045. That is hard cost to ARV rate of 65%. This is well within hard money lending guidelines. So this is a 100% financed transaction because all of the entry cost and purchase price will fit within the 65% ARV loan limits. And that includes 12% annualized monthly debt service rolled into the carrying costs. So you can borrow all the money you need to buy the property, to fix it up, to pay yourself, to pay a wholesale assignment if you're buying this from someone else, and to pay the monthly interest-only debt service, as well as the utilities and HOA. Now over here in Microsoft Word, let's bring up the summary template. And run the analysis for the hard money fix and rent scenario. Again, it's all laid out with what we estimate the ARV to be, subtracting our retained equity. Total investment to value is 70% of the ARV. This is the all-in investment. It includes the soft costs going out. These will be covered by the refinance loan when the property is refinanced. Now let's go to The refinance sheet. This is what we would use to request a letter of interest to refinance the property after completion of the project. There's no participation share, no commissions, no tenant improvements. We can just delete those lines. So we show the ARV, subtracting our 30% margin. We're asking for a 70% loan to value. We subtract the refinance cost, estimated at 2.5% of the refinance amount, and that leaves $97,695 to pay off the repositioning loan. And here are the terms under which we are refinancing. 70% loan to value, 5.25% annual interest rate, 300 months, that's 25 years. The annual mortgage constant, 7.19%. This is slightly higher than the annual interest rate because it includes principal repayment. We show the annual and monthly debt service, the capitalization rate, the debt yield, and the debt coverage ratio. And the pro forma operating data, when it's all fixed up and rented out to a retail tenant, we're guesstimating $1,200 per month as rent coming in, minus a vacancy and credit loss. There's no other income coming in. This is not an apartment building where you can charge for laundry and cable TV and things like that. Effective gross income minus gross operating expenses. We're assuming that the operating expenses are just taxes and insurance. Net operating income, this is the amount of cash available to service any debt. Subtract the debt service, and then we have our net cash flow. It looks like an 8.39% return on equity. The thing is, we have no net cash invested in this property, therefore the return on equity is actually infinite. This $300 per month in net cash flow is pure profit. If we wanted to wholesale this property to someone else, we would use the wholesale opportunity summary sheet showing what we estimate the ARV to be, the cost going in, the cost going out, and the financing of the property. We are calculating $6,400 assignment fee for this deal. You would only present this wholesale opportunity to someone else when you have the property actually under contract along with your financing commitment. You would also include, because this is a fix and rent project, you would include the income valuation. Your wholesale buyer can then look at this income valuation and check that it's reasonable. And that is the quick assessment for calculating the maximum allowable offer for a hard money fix and rent, hard money fix and sell project.